Hey guys, so we saw US markets drop last night, which spilled over into the Philippine markets as well, where we saw the PSEI drop massively. All of this was brought about by fears that there's a possible recession, that there are signs and signals that we may see a repeat of the 2008 recession. What is this all about? Is this just all noise? Or is there valid truths into this? That's what we're going to talk about in this video. So hi everyone, this is Marvin Gurman. I'm a stock market trader and investor. If you're new to this, subscribe, smash that bell so you get updated every time I produce new content all about the stock market, because the goal of this is for me to teach you, to educate you, that you don't have to be scared and intimidated when you trade the markets, because it can be done even if you're a business person, you're a student, you're an OFW, wherever you are in the world. You can use the stock market to trade and to help you reach your goals of financial freedom. So enjoy this video. Hi guys, so I'm back in Manila after that very action-packed weekend in Hong Kong with all of those delays and everything else in between. But tomorrow I'm flying out again for Icon Iloilo, which will be an amazing set of conferences with different speakers talking about investments and finance and the stock market. So the entire context of this video is brought about by the massive drop that we saw in global markets and in our own local market as well. So what is it all about? What's the biggest fear that has caused people to sell, that has caused investors to be fearful? So basically, markets drop because of the inverted yield curve. What is this all about, and what does this have to do with the stock market, and why is everyone so scared about it? For those who have been watching my channel for quite some time already, I already pointed this out around 4 months ago when the 3-month T-bill already had an inverted yield curve already with the 10-year bond. What does that have to do with everything? You have to put it this way. Short-term interest rates should give you lower yields versus long-term interest rates. Why? Because the longer the period, the longer the uncertainty, you must be compensated more. As compared to something that's short-term, the risk somehow should be lesser. But the inverted yield curve that I showed more than 4 months ago already showed that there's more fear in the short term as compared to the long term, which shouldn't be the case, because there should be more uncertainty for the long term as compared to the short term. In the same way, this is what we're seeing now. The biggest thing that caused markets to go down yesterday was basically the 2-year bond had now a higher rate of return than the 10-year bond, meaning also investors are saying that there's a larger amount of risk in the short term as compared to 10 years into the future. Again, in an inverted yield curve, which should not be the case, because there should be more risk in the long term as compared to the short term. So why is this so significant? Why is this so scary? Here's the thing. I already mentioned it once that there's a larger risk in the short term. People are pegging that there's larger risk today as compared to the long term. Majority of the crashes that we've seen throughout history, it all started with an inverted yield curve. Please remember this. The yield curve is not the cause of the crash, but it's merely a sign. It's merely a signal. Today, we already have 2 signals of yield curves inverting. The 3-month up against a 10-year bond, which happened a few months ago. Then the 2-year bond up against a 10-year bond, which happened yesterday. So those are just signals. Those are just signs. But people are pointing out that it's a precursor to something. But above and beyond that, I just like to focus on a couple of things that could be red flags already, and I've mentioned this in previous videos. Number 1 is Deutsche Bank laying off 20% of its workforce, one of the largest banks in Europe laying off its workforce, and that's something significant. Number 2, the trade war, which, here's the thing, it's not just anymore a trade war, it's spilling over to a currency war already, which is now hitting both the US and Chinese economy in all fronts, from agriculture to electronics. So here's how I think the trade war will go. Every time the US will put out a punch, China will always have a counterpunch, then the US will have another counterpunch, then China will have another counterpunch as well. And no one will win until they create, or until they have a settlement into all of this. The whole world will lose, because these are the 2 largest economies in the world. So the trade war is a much larger issue because it's not just anymore a trade war, it's spilling over into a currency war. Then the third thing that I'd like to point out is this. I think a larger domino that could cascade further are the student loans. There's massive amount of student loans that are not paid for, and people in the US just keep on getting debt, buying this expensive house, buying this expensive car, all at the same time they could not afford to pay their student loans. And I think when this falls, this could be one piece of the puzzle that could cause things to go spiraling down. We're not yet there, but this is a sign also that should it happen at a later point in time, this could press markets to go down, and this could press the economy also to go down as well. So how do you protect yourself in all of this? Cash is king. The more cash you have, the more options you will have, whether it be buying stocks that will be cheaper now or will be cheaper later on. That's one. Or you'll be able to find businesses that you could buy cheap when things go sour. Or in the same way, if someone is selling their properties because there's a recession, you will be able to get it at a cheaper rate. So at the end of the day, you prepare, you store cash, because cash is still an option. Cash will allow you to take opportunities when they arise. Second is gold. I really believe that when there's uncertainty, gold will be in the forefront of everything, that gold will appreciate in value. If you look at the 2008 recession during the crash, gold appreciated and hit its highest high. So to those who accumulated gold early on, when there was a lot of economic gains, when everyone was excited and you bought gold lower, congratulations to all of you. Because at the end of the day, gold also is not an entry-level investment. It would be better still for you to have stocks or businesses or other investments than gold, because gold doesn't give you cash flow. It's more of a good hedge. But for those who have investments already, gold is something good for you to protect you. And third, this is controversial and this is not one of the most popular ones, Bitcoin. Digital currencies, it's a good hedge should there be something bad that may happen to whatever currency or whatever economy should a collapse happen as well. So there, are we there yet? We're not yet there, but signs are coming. You have to remember, since 2008, we're 11 years out from it already, meaning it's not a question whether a recession will happen, it's a question of when, and it's a question of how prepared you are when those things happen. So you're not supposed to be scared about recessions, you're supposed to prepare. You invest as if a recession will never happen, but you prepare that as if you know and you know and you know that it will happen, that should it happen, you will win. In 2008, people talk about that it was one of the worst recessions ever, but people don't talk about those who took advantage of it, those who made money off of it, those who were prepared and did their job, did their due diligence, and they're the ones who made millions off of it as well. So comment below if you have questions. Comment below if you think a recession will happen soon. Comment below if this is nothing. It's just a short blip, short correction into a market that's higher already. I want to hear your thoughts. Send them below and let's talk about it. So this is Parvin Germo teaching you that you have to base your investment decisions from the data. Do not base it from your emotion, because if you base it from your emotion, that's when you lose. Because if you base it from your emotion, that's one of the biggest ways for you to lose money in the market. So I'll be in Dubai, Doha, Singapore, Iloilo, Davao, and Cebu, and also Metro Manila over the next few weeks to talk about the stock market. If you want to know more about it, the link is down below, and I hope to see you live. I hope to see you in person for those who want to learn in a classroom setting. So this is Marvin Germo. I hope this video helps you trade well, trade strong, trade smart. See you all again soon, guys, and God bless you all.